If you are retired, do you need life insurance? The answer is probably not. Most people who are retired do not have life insurance because they've built up a nest egg, they've got sources of income, and they're fine. They look at their situation and say, hey, I'm comfortable now. I do not need life insurance. However, when it comes to a cash value life insurance policy, the question here is how can it help? And really, can a whole life insurance policy enhance my present position in retirement? Meaning, can I maintain or enhance my present lifestyle? And then two, can it enhance my future position? Specifically when leaving money to my beneficiaries, a legacy really. And the answer is yes on both of them. Really, the core benefits of a whole life insurance policy when it is designed properly for maximum cash value, and we're going to get into exactly what that means and look at some real models in this video as well. But the core benefits are as follows. Laser focus on the cash value. It is a safe, liquid, tax-free area to position money. Typically, it'll grow somewhere between 3.5% to 5.5%, not tied or invested in the stock market at all. Very liquid, has a lot of benefits, but the key is truly maximizing it for cash value. Now, from a future benefit standpoint, death benefit proceeds are always paid out 100% income tax free. So the question is, can I leverage the benefits of both areas with everything else that I have going on? Taxes are a big part of the equation. We're going to touch on that a bit in this presentation as well. So let's get into it. What I want to touch on first, though, is the viewpoint. How we view the product is very important. Really, if I take an insurance policy, what comes to mind? It's a cost. I pay an insurance premium. If it's a life insurance policy, when I die, money's paid out. So how do I take that approach out the window and really view it as a means to reposition assets to this safe, liquid, tax-free area that has a life insurance benefit as well? But how do I simply, again, reposition assets where my actual balance sheet is not negatively impacted? And the policy design is critical. We're going to go into full detail on that piece as we go through this video. A policy must be designed for a minimum insurance expense, maximum cash allocation. That makes the difference from when people do this versus people that don't do it. When they look at it and say, there's no way I'm going to do this, versus someone that says, this is the best decision I have ever made. So what we're going to look at here is a case study. We've got a 65-year-old couple. So 65-year-old male, female, husband and wife. And here's their present situation. They have no debt. They've done very well. They've got their primary residence, their home, valued at about $400,000 presently. They've got money in 401ks and IRAs of about $2 million. They both worked throughout their lives and they've built up that nest egg primarily in the qualified accounts of about $2 million. They've got about $50,000 in cash, $250,000 in stocks and bonds, real estate, $1.2 million. That is primarily rental properties that are cash flow producing. In recent years, they've really made an effort to pay down all of the debt, all of the mortgages on those properties. This way they could use that for retirement income, and it's worked out quite well for them. So their total net worth is just under $4 million at age 65. Here's their present path. Their total household income is about $200,000, and that consists of the following. They have Social Security of about $45,000, and that's combined between the both of them. Rental income netting out at $75,000 per year, so that's after all of their expenses, a little bit over 6%. If you were to crunch the numbers, 6% would be about $72K based off the $1.2 million. And then the 401k and IRA money, what they did with those dollars is move them to conservative funds, assuming a 4% rate of return indefinitely, which will produce $80,000 per year. So what they're doing in this strategy is they've got their $2 million nest egg, living off the 4% interest only, $80,000 per year. That is taxed fully because it's a qualified account, all tax deferred, but it does produce 80 grand per year. Now, what we're going to look at here is assuming that they expire or they pass at age 90, what does it look like in terms of their entire legacy based on their current path? So as we look at this plan, what we want to look at is option A, before you met us, before you went through any planning, what was the current path you were on in terms of your income now and also legacy planning? And then when you do incorporate a cash value life insurance policy, how does it impact you presently? And then also from a legacy standpoint with your future position. So let's look at age 90. Right now, 401k and IRA money at 4%. At 90, we're just going to assume for simplicity that that balance will still be $2 million. The reason why is we're going to assume it produces 4% interest, which is $80,000 per year. They live off the interest, and then when they die, $2 million is passed. Now, granted, there are RMDs, required minimum distributions. Sometimes the interest will fluctuate a bit. In an actual plan, we would dig into that much further. For the sake of this model, we're going to look at 4%, keep it simple. Now, the stocks and bonds. So right now, he and she are at $250,000, earning 5%. It's money they don't really need right now. They're not planning on using any of it. The $200,000 per year is plenty for them as well from an income standpoint. So let's look at this growth assumption from age 65 until age 90, which would be 25 years. Okay, so what we're going to look at here, present value, $250,000. Assuming relatively conservative growth rate, really when I think about it, for stocks and bonds with what we've seen, but they want to play conservative. They do not want to go too aggressive. So 25 years, by age 90, I will have just under $850,000, $846. So what we'll do for this scenario is just round up. Let's keep it simple. $850,000 if they do not touch the stocks and bonds at all, and if we average out a 5% return over the next 25 years, which is very, very realistic. Even if they put in the S&P 500, it'll likely do better than that. Real estate. So we are going to assume a 4% appreciation rate, and what we're going to look at in this particular model is both the home and rental property value. So we have a total present value of $1.6 million, appreciating at 4%. Let's do the math. 1.6 million. Appreciation, 4%, 25 years. What does my total real estate appreciate to? Just over 4.25, 4.265. So let's round on this one again. The last one we rounded up, we will round down on this one. Keep it fair. We always like to shoot things conservative. If it works out for me, based on a conservative scenario where the numbers work and I'm comfortable with the plan, and then things produce greater value than those conservative figures, I'm happy. I love you. Okay, let's work together. If it's the opposite, if I show you great numbers to try and win the sale and then it under delivers or doesn't produce, you probably don't like me that much. So here we go. Total net worth. What do we have? The $2 million at age 90, plus these figures here, 850, stocks and bonds, real estate, 4.25. That comes out to a total of $7.1 million. And will likely be higher. The money they have in cash right now, that $50,000, that's just an emergency buffer. They don't really need it again. They live off of $200,000 per year. They live off of less than that. But right now they do have plans to travel a bit more, spend time with family. Their kids are out of state. They want to spend time with them as well. So they are going to try and use the money they earn rather than just save it, because their mentality is, hey, we retired now. We don't think we're going to run out of money. We're cash flowing very nicely with the real estate. Let's enjoy our retirement together. So here's their current plan. They're doing just fine. If they do nothing else, they will be okay. So again, going to the question, can cash value life insurance enhance my present position and then also enhance my future position? Let's have some fun. So to recap the current path they are on by age 90, here's what it would look like. We're going to break down these numbers here. What do we got? By age 90, income $200,000 plus. Why I have that plus sign there is it will be higher than $200,000 for a number of reasons. The big thing that jumps out to me is what? The real estate. That real estate will continue to appreciate. Likely, he will raise those rents over time gradually, just as the fair market value of the property increases, rentals increase everywhere else. That's common. That's a great thing about real estate. He has control. He's done that gradually over time as well. His home expected to appreciate to the $1,050,000. Let's validate that. Where we got that from is right now it's worth that $400,000, his primary residence, 4% interest rate, 25 years. Here we go. $1,066,000. So what we did again was just round down in this example. That's where we came up with the $1,050,000. Age 90, 401k and IRA balances are still at that $2 million. That was based on me just taking out, or them just taking out the $80,000 per year at the 4% interest, living off the interest only, and then the principal is passed to their beneficiaries. These stocks and bonds has accumulated to $850. We looked at that figure. Then the real estate. So this is primarily the rental property. So if we go back, right now we are at the $1.2 million as far as the total real estate or rental property value. So let's validate that as well. The appreciation over time. We've got 1.2 now. End of year, 4% depreciation. That's what they wanted to see for 25 years. There we go. Just about 3.2 million, 3.199, 004 to be exact. Okay, so that's where we came up with those values to total the net worth or legacy at age 90 for both of them at $7.1 million. Now, a couple of things we want to touch on here. The liquid pre-tax money is $2.85 million. Where that comes from is we've got the IRA and 401k at $2 million, and then also the stocks and bonds at $850,000. When I say liquid, I mean cash in some form. So when the couple passes, their children will receive this cash of $2.85 million. However, taxes are going to come out, especially on the qualified funds, the 401k and IRA money. Where that comes from, or the reason why, is qualified funds. If you're not super familiar with them, with a 401k, for example, all payments I make to a 401k are made with pre-tax money. So if I make $100,000 per year and I contribute $10,000 into my 401k, my earned taxable income for that year went from $100,000 down to $90,000. I was able to deduct that payment I made to the 401k, lowering my taxable income right now, deferring taxes for a later date. So with the 401k, all of the savings is done with pre-tax money. It grows tax deferred, and then when I begin to pull it out, I have to pay ordinary income tax on any distributions. If and when I die, when it is passed to my beneficiaries, they must pay ordinary income tax on the entire balance. If they receive it in one lump sum, they've got to pay taxes on everything. Typically, you do have the option to stretch it out over a number of years, but if this couple passes and it goes to their son, who earns $250,000 per year, if he does very well, when he receives that balance, it's going to be taxed as ordinary income, added on top of his present income of $250,000 per year, or whatever it is. So it's good to be aware of that. So why we've got liquid pre-tax is the cash he's receiving, pre-tax $2.85, the 401 and stocks and bonds combined, but then post-tax, after taxes come out of it, we rounded here to $1.5 million, depending on the children's situations, but a big bite is coming out in taxes. Now the real estate, we kept that the same. There will be taxes. A lot can happen with real estate. We work with so many people that invest in real estate and have different strategies when leaving it to their beneficiaries. So that will let you work out if you're heavy into real estate, or you can work with a tax professional, an attorney, but we're just going to assume real estate passed the $4.25 million, which is a combination of the primary home and rental properties that have accrued over time. That's where that 4.25 came from. So net proceeds that go to the beneficiaries, 5.75 million. This is on their current path. Now, one thing I want to mention here, and every family is different in this particular situation, is here, the majority of their net worth is being passed through what? Real estate, hard assets, not cash. The kids live out of state. The kids do not have experience with real estate. Now, some families we work with, their kids are directly involved with the parents in real estate and they know they can grow even faster. They're excited. So everyone is different here. But in this particular case, when this happens, a lot of times the kids end up selling the property quickly at a discount because they don't know what to do with it. They've got their own family, their own business, their own careers. They're like, I don't know what to do. I don't know who to hire. Who can help me with this? I'll just sell it at what seems fair. We've seen that and have heard of it more so happen several times just with different individuals. So it's something to be aware of or be mindful of, unless we've got a good property manager or an attorney that can help us here. So let's take a look at the alternative path now. So current, again, he's good. They're both good. Like when they die, 5.75 net proceeds, 1.5 million is still passed. That's the net amount in cash to their beneficiaries. To let you know, my dad, if he saw that, he would say, hey, you're lucky to be getting anything there. You're good with getting just that. He'd be joking because he wants to conserve principal, but you know, there's cash being passed. But again, can we enhance it? That's the question. Option A, current path. Now let's look at option B. So what we're going to look at here is how do I maintain my lifestyle, reposition assets into a cash value life insurance policy with guarantees. So we've got a guaranteed cash value interest rate on this product of 4%. This is before the new tax law change goes into effect, which impacts the guarantees, and then also leave a legacy. So here's what we got. The 401k at $2 million. This is the main piece of the puzzle here. That is producing that 4% interest in which the couple is just living off the interest each year. Net $80,000 per year. Here's what we're going to do. We are going to propose still living off of $80,000 per year, but we are going to drain that 401k and IRA over the next 15 years. So by the time they are age 80, we want that thing drained. Here's specifically what we're going to do. Distribute 180K. Actually, let's pause here and look at the numbers. Let's run this math. So what we've got, $2 million at age 65, annual interest 4%, 15 years. If we were just going to live off the interest only, taking out a flat withdrawal of 4% is 80 grand. What we're going to do instead, spend it down, pay down. So what this assumes is still earning 4% in the 401k, in the IRA, but instead of just taking out the interest, we're going to dip into the principal each year as well. So now this permits me to take out $180,000 per year. The thing to be aware of though, what's it look like year 15? Out of money. So we deliberately spent that down. Now, to emphasize this point, if we are going to spend down retirement assets, typically the first thing we want to spend is the assets we have the least amount of control over, particularly in respect to taxes. So qualified funds. If the government decides to raise taxes, what's going to be impacted more than anything else here? Money coming from the 401k. It is 100% taxed as ordinary income. So spending that down first allows us to get rid of it in a sense. And then if taxes are adjusted, if they go up over time, that money is impacted the most, but we're getting rid of it faster than anything else. So we decided to spend it down, $180,000 per year for 15 years. We're going to take $80,000 as income, exactly what we were doing before based on the current path. But then we're going to take $100,000 of that per year for the next 15 years and reposition that into a high cash value life insurance policy. Now, before we start going through the numbers and how that works, there's another piece, stocks and bonds. So we had that 5% interest rate assumption based on the $250,000. So going back, stocks and bonds, 250 at 5%, going to accrue to 850. All right, so instead of doing that, what we're going to look at here is the stocks and bonds at 250,000, 5%. 5 years, we're going to spend it down. There we go. So that produces about $58,000 per year in income. We're just aggressively spending down those stocks and bonds. This is an option. When we look at actual planning with someone, we're looking at more than just one option because there's always more than one option that exists. Numbers may look the best with one scenario, but what's your personal preference? What gives you peace of mind as well? That stuff has to be considered. Very important. So we've got the stocks and bonds. Gross distribution, $57,000 per year, but we're going to assume $50,000 per year going into the policy because we do have to deal with taxes. This whole situation has to deal with taxes. It's something we're not going to really dig into in this video because I'm not a tax advisor. We would definitely work with a tax advisor or involve someone who really understands this, really to model a comprehensive plan if that's what someone is looking for. But again, getting back on track, how do we enhance our present scenario? So what we've got here, as we progress on to the next piece. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.